Want to earn consistent and stable passive income? Looking for high-yield Canadian stocks to add to your portfolio? I'll be breaking down two strong and stable Canadian dividend stocks that are currently paying a great yield. Great news for my US subscribers, these are listed on the TSX and the New York Stock Exchange. I've invested in both of these stocks around 5 years ago. I've just been holding on and earning that passive dividend income. These have been my most popular videos. Both of these were requested by a subscriber, and it's just convenient that I actually hold these stocks. So if you've requested a stock analysis, hold tight, they're coming soon. Please thumbs up the video and subscribe for more content. Please remember to turn on the notification bell so you get a little ring every time I release a new video. First stock is Telus Communications, ticker symbol T on the TSX and TU on the New York Stock Exchange. Telus is a Canadian communications company with a wide range of products and services, including internet access, voice, entertainment, healthcare, video, and IPTV. They compete with Bell and Rogers in Canada and would be compared to AT&T in the US. Taking a look at the ticker on Yahoo Finance, they're currently trading just under $24 per share and pay an annual dividend of $1.17 per share. This equates to a 4.94% dividend yield. The dividend is paid quarterly. Not only have they been paying a dividend for 21 years, but they've been increasing their dividend for 16 years straight. They recently did a 2-to-1 stock split. If you remember seeing Telus trading in the $50 range, you are correct. I believe the final price was 50 or 51 before it was split down to 25 or 26 per share. The current price to earnings ratio is 20.33. To put this into context, the average for the S&P 500 is 15. But it would make more sense to compare Telus to their peers in the same industry. Rogers has a PE ratio of 16.36, whereas AT&T has a 17.68 PE ratio. Telus appears to be in the same range as their peers, which is a good sign and doesn't appear to be overvalued, but we can't count on this metric alone. The stock is currently trading at a 10% discount from its all-time highs in March, which isn't much, but analysts are predicting that it will return to its pre-crash price within 12 months. So not only will you be earning a great dividend, but you'll be double dipping in the income by earning great stock appreciation as well. I'm going to be taking at their Q2 financial statements. I know we're already into Q3 and their statements are 6 weeks away, but instead of waiting 6 or 7 weeks to release this video, I'll be releasing this video based on the information I have on hand, which is Q2. Revenues are up 4.5% for the first half of 2020 compared to the first half of 2019. That's a good sign. What's not good is net income being down 30% compared to last year. Now, any other time period, this would have been a concern, but given all the fun stuff happening in 2020, we have to give almost every company a pass if they have a dip in income in 2020. If you've watched my other videos, you know I like cash metrics. Cash provided by operating activities up 35% from last year. That's amazing. Free cash flow is up over 121%. The cash metrics for this company are looking great. Digging further, the dividend payout ratio is currently 61%, down from a super high 133% from the year before. I'll need to look into this number to see what happened last year. It's a healthy number when you consider banks to be around 40 to 50% payout ratio, but REITs are in the 80 to 90% payout ratio range. What this number means, of their free cash flow, only 61% goes towards dividends, with the rest available to be used to pay down debt or reinvest in the business. Here's a cool point. Reading this snippet, their long-term range is 60 to 75%. That means if their free cash flow keeps increasing, we're already at 61%. If next year it's at 55 or 50%, they'll probably be announcing a dividend increase to maintain this range. If you were to invest $1,000 into Telus, you'll be earning $49.40 per year in dividends, or $12.35 per quarter. They also have a dividend reinvestment plan. If you were to invest $2,000 into their DRIP, you'll be getting around 1 share per quarter in dividends. Let's quickly dive into their balance sheet. Current assets are a little less than their current liabilities. Ideally, I would like to see this around a 2-to-1 range, with current assets being twice as large as current liabilities so they can cover any immediate debt. If we look at their credit facilities, look at this table. They have a $2.25 billion credit facility with zero drawn. They have this entire facility available to fund any cash shortfalls. That being said, I'm not worried about any cash issues in the short term. Back to their balance sheet. Assets being at $40 billion, with liabilities being at $28 billion, seems great upon first glance. But if you watch my previous video, looking at these two numbers, Goodwill is $6.1 billion. If we needed to settle our debt, this can't be exchanged or sold for cash. This is nothing. Look at the number right above, intangible assets, $13.6 billion. Looking through the note, which breaks down everything in this 13.6, it's largely items that can't be sold. The balance sheet isn't as strong as I'd like it to be, but hopefully they can increase their assets while reducing their debt in the future. Even though we're still in lockdown and we're not out of the woods yet from this recession, Telus has shown their resilience with their strong revenue growth and their free cash flow growth in the first half of 2020. I will continue to hold Telus for the foreseeable future and recommend it to anyone looking to add a stable and consistent dividend payer to their portfolio. The second stock I'm recommending today is Manulife Financial Corporation, ticker symbol MFC on both the TSX and the New York Stock Exchange. Manulife is an insurance and financial service provider that operates as Manulife in Canada, but John Hancock in the US. Taking a look at their ticker, they're currently trading at $18.47 per share, down from their all-time high of $27. They quickly tanked over 50% to $12 per share during the March 2020 crash and have slowly been increasing ever since. Their current dividend is $1.12 per share, which equates to around a 6% dividend per year, but they pay quarterly. The price to earnings ratio is looking a little low. With the S&P 500 averaging 15, we'll have to keep an eye out for this. We can't judge a company based on this alone, but it could mean the stock price is too high if we're bearish on the insurance sector. Or it means earnings will increase if we're bullish. This is a very simplistic view. Again, we can't judge a company based on this alone. We have to dig deeper. Investing $1,000 into Manulife will give you a $60 per year dividend or $15 per quarter. They also have a dividend reinvestment plan. If you were to invest $1,300 into their DRIP, you'll be able to get 1 share as a dividend per quarter. Before I get into their MD&A and financial statements, being a little honest, I don't have that much experience analyzing insurance companies, so I'm doing a little learning on the fly here. What I like about Manulife's investor relations department is that they release these great summarized fact sheets about their performance. What's annoying? Spelling errors. Come on, people. These fact sheets keep boasting about their LICAT ratio, their strong LICAT numbers. Looking this up, it stands for Life Insurance Capital Adequacy Test. Just guessing based on the name alone, if all your insured clients die today, do you have the money to fulfill all their policies? It looks like Manulife has 155% of the capital required, which is above what I would expect them to have, which is just 100%. Look at this comment on their liquidity. I don't even have to look at their cash flow statement. Manulife is fully self-funded, meaning our businesses generate enough cash flow to sustain our operations without being dependent on the commercial markets or short-term funding requirements. This is great to see as an investor. They currently have $26.7 billion of cash or cash equivalents on hand. Looking quickly at their cash flow statement, we can verify their assertion. The cash flow from operating activities is $8.9 billion for the first 6 months of 2020, slightly down from 2019, but that is to be expected. This is a healthy number for a company this size. Taking a look at their 6-month income statement for 2020, we see mixed results actually. Revenue is up 4%, which is a great year-over-year increase, but expenses are up over 8.5%. The largest driver being insurance contract liabilities. Again, we can't place too much emphasis on these numbers during a recession. I'll have to revisit this at the end of the year to see their full year results. We're looking for trends here. At the time of this report, August 5th, 2020, we just don't have enough info. Not enough time has gone by. Spending a little less time on Manulife, I don't think the 6-month statements give us that much information on the company. I think more importantly to see what happens with this insurance company is to wait for the full year, see the full year results, see what happens in all of 2020. I will be doing a more in-depth analysis. I think they released their results February 2021. That being said, I don't think you should wait until 2021 to invest in this company. I still like Manulife, I'm still invested in it, I like the dividend, and I don't think it would be suspended or reduced anytime soon. Manulife appears to be in a good position to continue paying their dividends, if not increase it in the future. That's it for today, guys. Just a short video on 2 great dividend paying stocks that I own and recommend anyone in Canada or in the US looking to build a dividend portfolio should own as well. I've been receiving a lot of comments on stocks that I should analyze or ETFs I should take a look at. Don't worry guys, I see your comments and those videos will be coming out soon. I might have to take a step back from releasing so many videos as I'll be going to an office full time. but hopefully I can release at least one video a week. Thanks guys.